Hi everyone, welcome back to the channel. My name is Sebastien Boyer, the approved guy, and on today's video, we're going to be discussing the compound credit effect, why credit cards are so important. Without further ado, let's get right to it. So first of all, let's talk about what you need to know about credit cards. I don't only want to highlight the good things, but I want to make sure you're aware of the risks. Credit cards have a really bad reputation. And usually the reason is most people spend credit cards unwisely. They're not using it as a way of leveraging, but they're using it as a way to pay for things that they cannot afford, whether it be toys, gifts, clothing, food, or even vacation and travel. And if you're using your credit cards this way and you're not using it strategically, it can become bad debt. And it's very dangerous because it's so easy to spend, and credit cards unfortunately have compound interest. And simply what that means is the first year of using the credit cards, it's going to be simple interest, but the second year it's going to compound the interest from the previous year. So they take all the interest earned and they add it back to the balance. And so this is why if you're only paying the minimum payment on your credit cards, it seems like you'll never pay them off because you're always getting charged interest. Some credit cards also have fees, and of course, that even makes it worse. Some of them have annual fees, some of them have even monthly fees. So you want to make sure that if you are going to use credit cards, strategically, based on the strategy I'm going to explain, which is the compound credit effect, that you're using the right credit card. And of course, I can help you to understand credit better on a one-on-one consultation, to look at your personal credit, get you on track so that you ultimately can qualify for the type of credit cards that I'm going to be recommending that give you the benefits we're going to be discussing. You definitely never want to miss a payment because, of course, not only will you get a late fee, but after 30 days, it will appear on your credit report 30 days late, a month later, or 60 days later, 60 days late, and on, so forth, and etc. Unfortunately, it can get very dangerous if you're not being responsible using your credit cards and you don't have a strategy to pay. Another thing that most people are not aware of when it comes to your credit cards is that there's a difference between the due date and the reporting date. See, the due date is the date that the payment is due for that month. The reporting date is the date that the credit card company reports that payment to the credit bureaus. These are two different dates. The due date could potentially be, for example, on the 15th of the month, and the reporting date could be on the 13th of the month, which was literally 2 days before. So when you pay on the 15th, that balance from the previous month is going to stay on your credit report for almost 30 days. Right? So it's important that you verify with your credit card company what is the reporting date. You need to be very specific when you ask that question because they don't get that question often. It's typically what's the due date. So you kind of have to dumb it down and repeat yourself. Not the due date, but the reporting date. The date that you report my balance to the credit bureaus. And what you want to do is you want to try to make your payment at least 5 to 7 days before the reporting date. And this way, your balance that's being recorded to the credit bureaus is always the lower balance, not the higher balance. Okay, very important, guys, because this is the difference between you having a better credit score when you pay down a balance on your credit report. So always look for that. Check with the credit card company and verify what is the reporting date and make sure you pay that at least 5 to 7 days before the reporting date. All right, now, with that said, this is a strategy. And again, the reason why most people fail when using credit cards and it becomes bad debt is because you don't have any strategy and you're using the credit cards as a means of living above your ability to pay. Okay, so how and when should you use credit cards? So the right way to use credit cards, guys, is as leverage, where you're going to use the credit card to either invest to grow in yourself, in your business, or as a way to pay your bills that you can pay with credit cards and immediately pay your money back into the credit card. So you don't need the credit card but you're leveraging the credit card. This is Velocity Banking 101. The basic principle of Velocity Banking is to give every dollar at least 2 to 3 jobs before you put it back into the economy. So if you're using the credit card as a means of paying the bills, then what you're doing is you're velocitizing your growth. Why? Because of the compound credit effect. Why? Because you're going to get rewards points. You're going to get cashback points. You're going to get travel rewards. In some cases, there are credit cards that will give you 3%, 5% cash back. There are certain accounts that even go higher. Ultimately, with those rewards points, if you're paying all of your bills that you can pay using a credit card, and you're getting all those rewards points, cash back, and travel rewards through that credit card, and you're immediately paying that credit card, then guys, you're Velocity Banking. You're leveraging that credit to build up the points and to take advantage of the features of the credit card. This is going to give you a form of currency through the rewards, cashback, and travel that in itself can be a huge value to you. Some people travel without ever paying for flights, for luggage, or even hotel accommodations because of how aggressively they use the travel rewards through their various credit cards. Some people use the rewards points to buy gifts when it's Christmas or when it's birthdays or just to accumulate the points and then buy expensive items that otherwise you'd be paying out of pocket. So this is a form of currency. Ultimately, if you're strategic using the Velocity Banking strategy and the credit cards, you will be able to benefit from this. Now, another thing that's going to happen is if you use your credit cards wisely, you're going to get new offers from the same credit cards and from other credit card companies that offer you a 0% interest promotion, sometimes for 12, 18, or 24 months. Now, you want to be aware of certain credit cards that are typically attached to retail accounts that offer a 0% promotion, where if you don't pay it off during the 0% promotion, you get penalized with an accumulative interest from day one. That's very dangerous because if you don't pay off the entire balance during the 0% promotion, then just one day later, it's going to accumulate all the interest that you didn't pay from the beginning, and you're going to get hit with that in one shot. So you'll see that a lot of times on furniture retail credit cards, on appliances and electronics retail credit cards. This is the type of promotion that they'll offer. So be aware of the difference between 0% promotions that are going to accumulate interest versus 0% promotions where if you didn't pay off the entire balance during the promotion, then you're not penalized. Simply the balance that's left is subject to interest based on that monthly interest and the current balance at that time. So very important, leverage the credit cards, utilize them to pay your bills, immediately pay into the credit card. And it's very important that you make sure you're paying the credit card on the reporting date, at least 5 to 7 days before the reporting date, so that you're able to have your lower balance always reflecting on the credit bureaus. This is crucial because ultimately you'll always have the higher balance reflecting. And key is that you need to remember the difference between the reporting date and the due date. Okay, guys? So now, besides the 0% promotions, you can get balance transfers. So potentially, if you manage a credit card really well, and let's say it had a 0% promotion, and a year later you have a balance, you potentially can qualify for another credit card with another 18 to 24 months of 0% promotions. And then when the interest applies on the older credit card, you can balance transfer that to the new 0% promotion, which is going to give you more time at 0% interest. So if you use credit cards strategically and wisely, you're able to take advantage of these features and benefit from the rewards, the cashback, the travel, the 0% promotions, the balance transfers, and convenience checks. This is basically as good as cash. This is where you can literally write a check to a company who does not accept credit cards, and many times the convenience checks will have 0% promotions attached to them. So the compound credit effect is what happens when you use credit wisely, leveraging credit through the Velocity Banking strategy. So what's going to happen is you're going to just start getting limit increases, new 0% promotion, bigger offers and approvals with lower interest rates and, again, extended 0% promotions. And so the credit starts to compound. The size of the accounts compound, the limits, the functionality, the ability to take advantage of the points, the compound of the rewards points, the cashback, and the travel reports. These are things that are in themselves become their own currency. And the most important thing on top of all of that is that credit cards are revolving accounts. What a lot of people don't realize is that your credit report is only reporting what is an active account. What that means is if you have a loan, whether it's a school loan, car loan, mortgage, any kind of loan, it has a term. It's going to expire. And when that loan expires and you've made that final payment, logically, you and I might think that, well, I should be rewarded and I should get a bump up in my credit because I paid off the debt. But that's not what happens, guys. What happens is that loan gets reported to your credit report with a zero balance, and it is now a closed account. So therefore, it is no longer active, and it is no longer contributing to your active credit profile, to your active credit score. So you lose the valuable credit on anything that has a term. Okay, I have literally seen accounts drop within just a matter of days, 20 to 40 points, because someone paid off a car loan and the balance reported and the account was closed, where Friday the credit score was 800 and on Monday or Tuesday it dropped down to a 780 or even as low as a 750, depending on how much more credit you have to keep the scores up, because you do have to have a mixture of credit that gives you a strong credit profile. But with credit cards, these are revolving accounts. So the longer you have them, the older they are, is the more seasoned the credit. And the larger the limits is the larger approvals you'll be able to get access to. Ultimately, someone who has seasoned credit cards, 5, 10, 15, 20 years with high limits will be able to access much higher approvals in funding, as well as their credit scores are going to reflect all of that seasoned active credit activity. And again, as long as you take good care of your credit cards, they're not going anywhere. Now, of course, credit card companies do reserve the right to cut, close, or reduce credit card limits at any time. But again, if you're using your credit cards aggressively and paying them aggressively, where you're not carrying high balances, most of the time you're not going to see a credit card closure or reduction. Now, if you sit on a high balance for too long, then you can anticipate there's a good chance they might close the credit card. So guys, if you want to talk to me more about personal credit and understanding how to establish and build your personal credit, or if you have issues on your personal credit that need to be repaired or restored, I can provide you a free consultation. Just go to theapprovedguy.com. You can click on the link in the description below as well, and you'll see all of my services. Click on the personal credit consultation, schedule a free call. I'm happy to spend a little time with you, understanding your situation, giving you some tips and advice. And if you want to go through a full analysis and a consultation, we can discuss and negotiate that. I hope this video was of value to you guys. Please like, please subscribe, share, and gently click on that notification tab. Guys, thanks for watching. As always, it's the Approved Guy, and make it a great life.